Guys, I've made my living as a trader since 2016, and I've done so using one simple concept: mean reversion. Even just this week, I caught the very top of the gold market and I've secured even more prop firm funding. Stop wasting your time with overcomplicated systems and a million discretionary rules and learn a basic mean reversion system from me in this video. Let's jump in.
Okay guys, so something really important to understand is no market in the world just does this. It doesn't just continuously go up. Every market will breathe. It will push and pull. If it's in an uptrend, there'll be retracements in that uptrend. There'll be these areas here where there's pullbacks. Equally, if it's in a downtrend, it will do the same. Unless it's like a meme coin or something, a meme coin can just massively overextend, but then the harder the push, always the bigger the retracement. So remember that. That's your first rule to remember. The harder we push and the more we push in one direction, the more we're going to retrace, the harder we're going to retrace. That's mean reversion. And mean reversion is usually coincided with something like a moving average, which I'll show you in a second. But if we have a moving average following price, we can see that this is the average price, right? So this is the average over, let's say it's the 50 period moving average. We know that that's the average price over 50 bars. Well, the average is going up over time. So the average price is increasing, but we will always eventually correct back to the average price. You won't find a market anywhere in the world that hasn't corrected back to the average price at some point. Yes, the average increases over time, but we will always revert back. And that's mean reversion. The mean is the average, and reverting back to the mean is mean reversion. So how does this look on a chart? Well, if we look at something like the gold chart, now we know that gold's been really bullish over the last few weeks. I think since August, we started to see a big influx of buyers. We've hit this massive uptrend, right? We've pushed to the upside heavily. Now, the only trades I've taken on gold have been gold sells because they're mean reversion trades. I had a short over here and I had a short here. They're the two trades that I've taken on gold as mean reversion setups. But let's look at the last one. So let's look at the one that only just occurred yesterday, because this is really, really relevant, and this is going to help you massively in identifying your own levels and your own trades. Now, everybody knows different price action structures, double tops, head and shoulders, etc. They work, but they work with context. If we add a moving average to this chart, so I'll add several, you can see that, let's say this one's the 50, this one is the 100, and this one's the 200, EMA, exponential moving average, right? You can see that the last time we touched the 50 was here, back in the 19th of September, on the 4-hour time frame. On the daily time frame, we touched the daily on the 20th of August. We haven't touched it. Remember what I said at the start? The market always reverts. It always comes back. It's about timing that entry. Now, you guys know that I use supply and demand. If you don't know that, then go back and watch some of my other YouTube content. Supply and demand is the foundation of my edge. Well, what happened on gold was we had this clean area here of supply. And we came up, we dropped off initially. So there's a big influx of sellers here. The sellers were outweighed, the buyers took over, price pushed back into this area of supply. Now this was around like 8:45 UK time, a couple of nights ago. I actively took a sell entry as soon as we tapped into that level, because I was interested in that. Everyone that's joined this drop here is now potentially getting taken out of break even, or they kept their stop just above that high, 1 pip above, it got taken out. But everyone that thought that's the correction got taken out. I just simply waited for an area of supply. Now, because this is the all-time high, if we look left, there is no area of supply. So there was nothing here for me to sell. So I can't sell this level. But what I have to wait for is for structure. So I have to wait for an area of supply to form. I have to wait for the sellers to show up. Then I have to wait for the buyers to push price back into this area and drop it. Now, why did it drop so aggressively yesterday? This is one of the biggest moves on gold that we've seen. Look at the daily candle. It's absolutely huge. You'll be hard pressed to find a daily candle of that size on this chart, on this asset. Why did we drop so much? Well, think in logical terms. So the influx of sellers show up here. And if institutional money is wanting to sell this market here, they're unlikely to be filled at this point. And what will they do? They'll typically drive price back up to refill orders, to fill their remaining sell orders before the larger move. Now, this wasn't mean reversion because, look, we didn't touch this moving average. This moving average is a 50 period, 4-hour moving average. Yesterday, I took my profit before that. So there's a 1 to 8 here down to this level. I took profit actually slightly earlier than that. I was out of this trade at 1 to 6, which was, in fact, the reason it was a 1 to 6 for me was because I had a slightly larger stop loss. So it was around there, so something like that. But for me, that was the trade. It was down to that area, that first area of structure, which also coincides and happens to be, if you look on the 1 hour, an area of demand. So we had that area of demand there. So that for me was a sensible target. Now, obviously, price continued even lower. And it goes back to exactly what I said at the start of this video. The harder the push, the bigger the drop. Equally, the bigger the drop, the harder the push back up. Markets are cyclical. They work through mean reversion. They never just go up forever. If you look around global economies, if you look around the news this last couple of weeks, people are buying gold. People are flocking to like gold exchanges to buy gold here. Over $4,000 an ounce. That's when everyone's got interest in buying this. But this is the worst time to buy because the market is overextended. This is basic overextension, and no market ever just goes up forever. Now, how else can this look? Well, sometimes we're actually trading with the trend. So you might think that my only trades are always counter trend. So it'll be like the top here and the correction, but they're not. Sometimes they're with the trend. How does that work? So if we look at this market here, we understand that every time we push, we have a retracement. Let's say this is the 4-hour time frame or the daily time frame even. This area here, this pullback on the 1 hour, it could look something like this. Because that's just the higher time frame. The higher time frame is in an uptrend, but through here, the lower time frame is in a downtrend. Now that lower time frame downtrend, again, could be mean reversion because I could be looking for the buy here. It's all about the context of where you have your moving average, what time frame you're on, because the moving average here is going to be like this, right? Whereas the moving average here might be like this. Well, we've made a mean reversion here back to the moving average. Equally, we've then overextended to the downside on the lower time frame, and we've made mean reversion there back to the moving average. It's really simple. It's a basic concept, and it just indicates that what you're taught from the very get-go, which is buy low, sell high, it pushes that narrative because we are essentially trying to buy low and sell high. We're not trying to get into the market here for continuation downside to the downside. Equally, we're not trying to trade these very small reversions because the lower the time frame, the mean reversion, the less weight it holds. Obviously, we do our top-down analysis. Starting on the higher time frame is going to give you way more conviction. But it's a really simple principle. We're not using anything complicated. We're not looking at different session times, Asia sweeps, liquidity sweeps. We're not looking at any of that. We're just looking at a basic principle. If the market is getting overextended from the average price, it will revert back to the average. And it's not just forex markets, commodities, stocks. It's not just that does that. This will happen in the housing market. It will happen in the used car market. It happens in the Rolex market, watch market, luxury watches. It happens in any market, but it's about understanding that that market will not go up forever. To catch the top, to catch the bottom, check out some of my other videos. One of the other things that I've got is a free resource below this video, and that will show you exactly how you time these entries. So grab that free PDF, look at how you time these entries, and then you're guaranteed to get better profitability out of your trading.